You walk into a bank, deposit $1,000, and they give you maybe 1% interest per year. That's $10. Meanwhile, that same bank just reported $3 billion in quarterly profits. So what's actually happening to your money? And how exactly do banks turn our deposits into these massive profit machines? Today, we're breaking down the real mechanics of how banks make money. No jargon, no complexity, just the straight facts about one of the most profitable industries in America. Let's start with the most fundamental way banks earn money, the interest rate spread. It's actually pretty straightforward when you think about it. When you deposit money into your savings account, the bank pays you interest. Right now, a typical savings account might give you somewhere between 0.4 to 1% annually. Some high-yield accounts might offer around 4%, but those are the exception. Here's where it gets interesting. That money you deposited doesn't just sit in a vault. Banks are legally allowed to lend out most of it. And when they do, they charge much higher interest rates. A personal loan might carry an interest rate of 8 to 12%. Auto loans typically range from 5 to 10%. And credit cards? Those can charge anywhere from 18 to 25%, or even higher. So let's do simple math. If a bank pays you 1% interest on your $10,000 deposit but lends that money out at 8%, they're making a 7% profit on your money. Multiply that across millions of customers and billions of dollars, and you start to see where those enormous profits come from. The Federal Reserve requires banks to maintain a certain percentage of deposits as reserves, while the remainder is actively working to generate returns. This difference between what they pay depositors and what they charge borrowers, that's called the net interest margin. And it's the backbone of traditional banking profits. But interest isn't the only revenue stream. Banks have developed dozens of ways to charge fees, and these add up to substantial income. Overdraft fees are one of the biggest. If you spend more than what's in your checking account, many banks will charge you around $35 per transaction. Some people get hit with multiple overdraft fees in a single day. Consumer advocacy groups estimate that American banks collect roughly $8 billion annually just from overdraft fees. Then there are monthly maintenance fees for checking and savings accounts. ATM fees if you use a machine outside your bank's network. Wire transfer fees. Cashier's check fees. Early account closure fees. Foreign transaction fees are charged when you use your card internationally. Each fee might seem small, $3 here, $15 there. But when you have tens of millions of customers, these charges generate billions in revenue every single year. Banks also earn money from interchange fees. Every time you swipe your debit or credit card, the merchant pays a small percentage to the bank that issued your card. It's usually between 1 and 3% of the transaction. You don't see this fee, but it's there, and it's another massive revenue generator. Larger banks don't just handle deposits and loans. They're also major players in financial markets. Many banks have investment divisions that trade stocks, bonds, currencies, and commodities. They're buying and selling on behalf of clients, but they're also trading with the bank's own capital to generate profits. This is called proprietary trading, and while regulations have limited it somewhat, it still happens. Banks also underwrite corporate bonds and initial public offerings. When a company wants to go public or issue debt, it hires banks to manage the process. The fees for these services can run into millions of dollars for a single transaction. Additionally, banks invest customer deposits in various securities, government bonds, mortgage-backed securities, and other financial instruments. These investments generate returns that contribute to the bank's overall profitability. The wealth management divisions of major banks manage trillions of dollars in assets for high-net-worth individuals and institutions. They charge management fees, typically between 1 and 2% of assets annually. When you're managing that much money, even 1% represents enormous income. Mortgages deserve special attention because they're so profitable. When you take out a 30-year mortgage for $300,000 at 5% interest, you'll end up paying back nearly $580,000 over the life of that loan. That's $280,000 in interest. Now, many banks don't actually hold onto your mortgage for 30 years. They often sell mortgages to other financial institutions or government-sponsored entities like Fannie Mae and Freddie Mac. But even after selling the loan, banks usually continue servicing it, collecting your monthly payments, managing your escrow account, handling customer service. They earn servicing fees for this, typically around 0.25 to 0.5% of the outstanding loan balance annually. It might not sound like much, but when you're servicing billions in mortgages, it adds up quickly. Banks also make money from origination fees when you first take out a mortgage. These can range from 1 to 3% of the loan amount. On that $300,000 mortgage, that's $3,000 to $9,000 right at closing. Here's what really amplifies bank profits: scale. When you're operating with billions or trillions of dollars, even tiny percentage gains translate to massive absolute numbers. A bank that maintains a 3% net interest margin on $100 billion in loans generates $3 billion in interest income. That's before we even count fees, investment returns, and other revenue sources. The largest American banks, institutions like J.P. Morgan Chase, Bank of America, and Wells Fargo each manage assets exceeding $1 to $3 trillion. Their quarterly profits regularly exceed $5 billion. That's more than many Fortune 500 companies earn in an entire year. So there you have it. Banks make money through interest rate spreads, countless fees, investment activities, mortgage servicing, and the incredible advantage of operating at massive scale. Each component might seem reasonable on its own, but together they create one of the most consistently profitable business models in modern history. The next time you check your savings account and see that modest interest payment, you'll know exactly where the rest of the value is going. Understanding how banks work helps you make smarter financial decisions. And maybe even find ways to minimize the fees you're paying. If you found this breakdown helpful, consider subscribing for more plain language explanations of how money actually works in America.